Hi, I'm Todd Rosenbluth, and welcome to another episode of ETF360. I'm excited to be talking about emerging markets and China ETFs in particular with Andrew Mattock of Matthews Asia. So, Andrew, thanks for joining me.
Thanks, Todd.
Well, it's great to have you here. So, we're talking about emerging markets. They bounced back to start 2023. Why do you think that happened?
Yeah, well, we had the one big positive development when it comes to emerging markets, and that's really, China reopening coming out of what you would call dynamic zero COVID, which really did just cripple economic growth across the board in China, geographically, but also in many, many different sectors. So the fact that we've come out of the COVID period, looking, to some degree back to normal, I think is a huge positive, not just for China, but for the rest of emerging markets. I mean, China feeds, lots of the emerging market complex when it comes to, its power really in terms of, commodity prices and everything else. So, the big positive I think is, let's get back to normalcy in China. Let's get back to decent growth and, look forward to 2023.
So, specific to China, what are some of the positive developments we've seen in January and February to start the year?
From a stock market performance perspective, when you look at just the pickup in general activity, and what people have to understand is that when you're in such a a very rigorous testing regime, which they did have, it affected pretty much every part of their economy. So we've seen the signs, if you like, travel's picking up across the board. People are looking to book airline tickets. Even overseas travel now is coming back. But there's also just simple things like going to restaurants, the sentiment effect of not having to wear a mask, social interactions. It just leads to a lot of positive developments at a corporate level across the whole complex, advertising, you name it. So I think, just again, getting back to normal, I think from a corporate earnings perspective, feeds through to many, many, many different parts of the Chinese economy.
So MCH is the Matthews Asia ETF that's targeted towards the Chinese market. Let's talk. Ed, you're obviously a part of the team running that. Could you just talk about the investment approach?
Yeah, the Matthews China Active ETF, as you mentioned, MCH, space US. The approach there is, really firstly to invest in every part of China, irrespective of where it's listed. So, the Chinese stock market's in different spots. You've got Shanghai, Shenzhen, dominated by local investors. You've got the Hong Kong market, and of course, overseas listed US ADRs that are dominated by foreign investors. So, the strategy of the fund is designed to go anywhere in any part where Chinese stocks are listed, and to pick out the best opportunities across the board. Growth at a reasonable price. China is a growth market, and when I say growth, I mean earnings per share growth. So we're looking for companies with above average earnings per share growth, but we don't want to overpay. 1 or 2, maybe 3 PE points more than the overall market, but this is not growth at any price. This is growth at a reasonable price. Also, we're trying to keep the portfolio fairly concentrated where we can. So you'll see that the top 90% of the fund is concentrated in around 40 stocks. Keep it relatively concentrated, try and generate alpha. And I think lastly, it's China in terms of the stock market, it is what it is. Is the manufacturing center of the world. What you get with that is you get long-term buy and hold type opportunities, but you also get short-term cyclical elements that are associated with being a manufacturing powerhouse. So the fund will also go anywhere in terms of sector exposure as well. It's not just what you would call consumer discretionary staples. We have exposure to industrials, materials, real estate, financials, and the broking side. So the fund also has a very diverse range of options available to it when it comes to the type of company that we'll buy.
So, Andrew, you talked about the flexibility to invest in any part of China and in any of the sectors. That highlights some of the active management components. Could you just dive a little bit deeper there?
Yeah, I mean, at the moment, when you look at where we think the opportunity set is and the portfolio positioning, the market really bottomed, October 31st, pretty much on the day, believe it or not, 2022, rallied very aggressively. And look, a lot of that performance actually came out of the Hong Kong and US listed overseas market. And I think the opportunity set there when it comes to platform companies, the big dominant, consumer discretionary companies in things like food delivery and e-commerce, cloud. I think there's a way to go in terms of performance there. I think the valuations of these companies are still extraordinarily cheap for what they are. So I think that's one element. You have found at the same time the A-share market has underperformed in the same period. But looking at the A-share market, sentiment improving, the nature of the market when it comes to retail investors, the confidence that's building on the mainland itself because of economic growth. I'd like to think that domestic or retail participation in the Shanghai and Shenzhen market is yet to come. And there's many great opportunities there in terms of the structural growth sectors that are emerging in China. Automation, IT hardware, IT software, solar, renewable, all types of renewable energy, both solar and wind, EV car penetration. So a lot of these exciting areas are also reflected in the Asia market. We haven't seen a massive boost there from, again, the 31st of October, but, I think things will liven up, over 2023.
Andrew, thanks for that. Appreciate the added insights to dive deeper into this. Please visit etftrends.com. Thank you, everybody, for tuning in to ETF360.